These talks are brought to you by Claritax Books and are proudly sponsored by Six Forward Capital Allowances.
Welcome back to our series of talks on capital allowances. As we draw to the end of the series, I'm going to finish with an overview of two other types of allowance. This week we consider business premises renovation allowances, or BPRAs, and the final talk next week will look at research and development allowances. The rules for BPRAs are given at Part 3A of the Capital Allowances Act. They offer tax relief for the costs of renovating or converting certain unused business properties. The scheme was due to expire in April 2012, but has been extended for a further 5 years. The scheme enables businesses to claim full and immediate tax relief for the costs of renovating or converting property that has been vacant for at least a year, so as to bring it back into business use. The property must be situated in a designated disadvantaged area of the UK. The rules were tightened for expenditure incurred from April 2014. The starting point is that the expenditure must be incurred in connection with the conversion or renovation of a qualifying building or on incidental repairs. The end result must be that the building constitutes qualifying business premises, i.e. not a dwelling, but suitable for use for business purposes. The expenditure will qualify only to the extent that it is incurred on building works as such, on certain related professional and planning costs, and on statutory fees or permissions. A de minimis rule does, however, allow certain other minor costs to be included. HMRC give the example of Jasper, who buys a warehouse situated in a disadvantaged area that has been unused for 3 years, and he converts it into a hotel. The cost of buying the warehouse and the land on which it stands will not qualify, but the costs of converting it to a hotel will. If Jasper creates a basement for the hotel because he needs more storage space, the expenditure on creating the basement will not qualify. Since April 2014, fewer fixtures qualify for relief under these rules than was previously the case. All integral features qualify, as do certain alarm systems, cabling, sanitary appliances, catering facilities, and various other specified assets. The full list is at section 360B, subsection 3A. Relief is only due under these rules for so-called qualifying buildings. These buildings must be in a disadvantaged area as defined by the Assisted Areas Order 2014. If a building straddles the border of a designated area, the legislation requires a just and reasonable apportionment to be made to determine the level of qualifying expenditure. The building must have been unused throughout a period of at least 1 year before the renovation work begins. The last use must have been broadly for business purposes and not as a dwelling. The 2015 First-tier Tribunal case of Cenex Investments provides some useful analysis of how the concept of qualifying buildings should be interpreted in borderline cases. Where the conditions are met, relief is usually by way of 100% initial allowances, given for the chargeable period in which the expenditure is incurred, even if the property is not ready for use until a later period. In some circumstances, an initial allowance will subsequently be withdrawn, for example if the property is sold before the work is completed. In other cases, the allowances will be retained as long as, broadly speaking, there's no balancing event within 5 years of the date on which the renovated premises are first used. So that's it for a very quick overview of business premises renovation allowances. Our final talk next week will provide a similar overview of the rules for research and development allowances. Thank you for watching. I'm Ray Chidell, author of Capital Allowances and of the A to Z of Plant and Machinery from Claritax Books. This talk was sponsored by Six Forward an independent property tax consultancy working with accountants to enhance capital allowances for their clients.